Welcome back to the Capital Breakdown, where we turn the complex world of finance into something you can actually understand and use. Today we're tackling a classic money question. If you suddenly get a lump sum, maybe a bonus, inheritance, or sale of an asset, should you invest it all at once, or ease in gradually through something called dollar cost averaging, or DCA? This isn't just a theoretical debate. It's about how to put your money to work in the real world. Balancing risk and reward. So what does history actually show? Stick around, because we're unpacking data, behavior, and market realities to help you feel more confident about deployment strategies. First, let's clarify the two approaches. Lump sum investing means putting your entire amount to work immediately. Think of it like jumping into the pool all at once. You're fully invested and ready to ride whatever waves come. DCA, on the other hand, is like dipping your toes in slowly, spreading your investment over weeks or months, buying smaller chunks along the way. The idea is to reduce the risk of mistiming the market by averaging your purchase price. Both methods have pros and cons, and they come down to managing uncertainty and emotions as much as math. Now, here's where history gives us some perspective. Backtests using broad stock market indices, like the S&P 500, generally show that lump sum investing tends to outperform DCA over the long haul. That's because markets historically rise more often than they fall. When you invest all at once, you get more exposure to those gains. But here's the catch. Lump sum can feel riskier, because if you invest right before a downturn, your portfolio dips immediately. DCA cushions that by buying in over time, potentially lowering the average cost if prices decline during your entry period. Behavior plays a huge role here. Humans aren't always rational calculators. We're emotional creatures. Imagine getting a big check and immediately investing it all, only to see the market drop the next day. That sting can lead to panic selling or regret. DCA can help manage this emotional risk by giving you time to adjust and preventing the all eggs in one basket feeling. In fact, many financial advisors suggest DCA not just as a mathematical strategy, but as a psychological tool to keep you invested and calm when markets get choppy. Let's zoom out for a moment. The effectiveness of either strategy depends on your personal goals and timeline. If you're investing for decades, lump sum might make more sense given historical market growth. However, if you're closer to needing that money or concerned about volatility, gradually deploying capital can reduce the short-term risk of losses. And remember, this isn't about perfect timing. It's about setting yourself up for consistent progress without unnecessary stress. Your comfort level with risk matters just as much as the numbers. It's also important to consider the type of investment. The S&P 500 and broad market ETFs cover hundreds of companies, providing diversification that helps smooth out volatility. But what if you're looking at a single stock, a sector fund, or leveraged products? These carry higher risk and greater price swings. In those cases, DCA might offer more protection against big drops. Conversely, lump sum investing in a highly volatile or concentrated portfolio could mean bigger swings in value, so the stakes are higher. Always keep in mind that with greater potential reward comes greater risk. Backtesting is a powerful tool here. It's basically running simulations of what would have happened if you used lump sum or DCA during different historical periods. Data from various market cycles shows lump sum wins about 2/3 of the time for broad market investments, mainly because markets tend to rise over time. But DCA wins in bear markets or periods of high volatility by avoiding the pain of investing a large sum right before a crash. So, no one strategy is perfect, and context matters. It's about choosing the approach that fits your timeline and emotional tolerance. An interesting twist is that DCA isn't just about timing the market, but also about creating a disciplined habit. If you don't have a lump sum but invest regularly through monthly payroll deductions or automated contributions, you're effectively practicing DCA. This consistent approach can build wealth over time, help you avoid trying to guess the best moment, and reduce emotional decision-making. So whether you have a windfall or steady income, dollar cost averaging can be a powerful tool to stay invested and grow steadily. One thing to watch out for is fees and taxes. If you're spreading your investment out over many months, transaction costs could add up. especially with smaller amounts or higher commission fees. Similarly, selling partially or timing trades within taxable accounts can create tax events. Lump sum investing, by contrast, might minimize these costs since you're making fewer transactions. Always be mindful of how fees and taxes impact your net returns. They're often overlooked but crucial for your bottom line. Now, let's talk about risk tolerance, a key piece of the puzzle. If you're someone who loses sleep worrying about market dips, DCA might help you avoid the anxiety of having a big chunk invested before a downturn. Conversely, if you're comfortable with market ups and downs and focused on long-term growth, lump sum investing might be less stressful and more efficient. Know thyself. Your emotional response to risk can influence your investing behavior, which in turn impacts your outcomes. The Capital Breakdown is all about helping you find what works best for your mindset and goals. Remember, no strategy eliminates risk. Markets can be unpredictable, and past performance doesn't guarantee future results. Whether you choose lump sum or DCA, diversification across asset classes and sectors is essential to manage risk. Also, make sure your investment choices align with your financial plan and time horizon. If you're unsure or feeling overwhelmed by these decisions, it's a smart move to consult a qualified financial professional who can help tailor a strategy that fits your unique situation. To wrap up, lump sum and dollar cost averaging both have strengths and weaknesses. Historical data favors lump sum for higher long-term returns in broad markets, but DCA shines in managing emotional risk and volatile periods. Your decision should reflect your timeline, risk tolerance, and comfort with market fluctuations. The best approach is one that keeps you invested, confident, and moving toward your financial goals without unnecessary stress. Here at the Capital Breakdown, we want you to take control with clarity and calm. Thanks for joining this deep dive on lump sum versus dollar cost averaging. Investing isn't about chasing quick wins. It's about steady, smart choices that fit your life. Do your own research, stay curious, and don't hesitate to seek professional guidance when needed. That's how you build a solid financial foundation. Stay tuned for more practical insights right here on the Capital Breakdown, where we break down money matters so you can break through financial confusion. Until next time, keep learning and keep growing. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.